Is the U.S. housing market about to crack, about to break down lower? A lot of folks have looked at their favorite growth stocks down 70 to 80%. Look at the major U.S. indices, also down 20, 30%. You're not even safe investing in U.S. treasuries, which have gotten hammered with higher inflation. But one safe haven has been with the U.S. housing market, which had rallied very nicely. And folks are wondering, will this sustain? I don't think so, folks. If anything, I think you should expect to see the home market, U.S. home market, crack and expect lower prices. This is my own personal take within the next few months and potentially quarters ahead. Let's talk about why. First, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. Let's dive right in to understand what am I seeing and what's sort of driving the concern that home prices could break lower. So first of all, you saw inflation effectively come in red hot today, around 8.6%. Not surprisingly, fixed income securities like mortgage-backed securities are just getting absolutely bludgeoned with a 30-year fixed rate now nearly 5.9%, nearly 6%. It jumped, the interest rate on a 30-year fixed jumped by 30 basis points today. This is going to make it much harder for folks to afford new houses. You look at effectively an index of mortgage-backed securities, and you see that the prices are just rapidly falling off. The bid is getting pulled back as folks are concerned about, hey, inflation is so hot, you're going to have to see much higher interest rates, and ultimately that's going to impact the market. And so this marketplace is not healthy. This is a clear warning sign. Credit leads, what you should expect to see with home prices. And so I think this is a clear warning sign. And not surprising, if you look at this sort of light blue area, this shows the amount of mortgage applications based on an index showing, wow, this is just completely falling off a cliff over here. And this golden line shows effectively what interest rates are doing. Now it's even closer to 6% when you update it for today. So the amount of mortgage applications coming down, that will be a headwind for U.S. home prices. Now, next up, you might start saying, well, is this like the Big Short story where home prices collapse leading to a devastating economic toll? Well, let's first understand what was sort of Michael Burry, the guy that this story was based off of. Batman, the original Batman, Michael Burry was based off of. To say, hey, what analysis did he use to determine that the previous housing bubble that preceded the great financial crisis, was a problem. And so what he saw, the crux of his thesis was that he saw that there was 20% income growth from, let's say, 2000 to 2006, 2007. And he saw, okay, so the median household income grew about 20%. But he also saw that the average home price from around 2000 to around 2007 went up about 70%. And so that's a huge mismatch. How could households all of a sudden afford more house, 70% more house relative to income? Especially when you look at long-term home prices and you see that there's pretty strong correlation between how much people make and the home price. And so you see steadily, it sort of stayed in a range for several decades. It didn't go crazy like this where, if median household income went up 20%, you generally see home prices go up around 20%. You wouldn't see home prices go up 70% plus. And that was his saying, oh, I need to dig further to understand how did all these buyers get extra firepower when they were coming to the market to say, hey, they had more dry powder to go buy stuff. What was it that did it? And so what he, discovered when he was looking into it was that it effectively was a bunch of, crappy loans. Ninja loans was, one of the hot things at the time, adjustable rate mortgages. Ninja stands for no income, no job, no assets. And effectively the way that they were able to make up this difference between a 70% increase in home prices and only a 20% increase in income was that they said, well, we'll accept anyone. We don't really care if you can afford it. So their underwriting standards went down. That's the way to think about it. It wasn't necessarily that interest rates were rock bottom, even though they had come down a bit. It's that the underwriting standards, whoever could get a loan could, even if you didn't even have a pulse in some cases. Even if you were flipping multiple condos spinning around a pole. And so, God bless. But, that was the problem of lowering underwriting standards. Now, what's happened since? Well, you look at, effectively median household income up nearly 40% since that time period to now. Now, what's happened to home prices? And home prices are up closer to 60%. Now, that's problematic because that's effectively saying, you know how overstretched things were in effectively preceding the great financial crisis? It's now even more overstretched. Now, when I see something like this definitely does get me a bit worried. I'm thinking, goodness gracious, whenever you see an asset go parabolic, go straight up like that, go above trend, and you've certainly seen it recently in U.S. national home prices, that should be an alarm to you that, wait a second, no tree grows to the sky. This could be big, a big challenge, let's say, over the next few years. And people should be prepared for that. Now, the difference here is unlike what we saw in the previous cycle, where effectively interest rates were single digits. The reason why, mid to high single digits, the reason why, effectively you could have this divergence between what people could afford, that household income going up 30, 40% versus home prices going up 60%, the main delta wasn't that the underwriting standards dropped significantly, but that interest rates driven by the Federal Reserve were even lower. We're close to rock bottom. You're looking at 30-year rates around 2-3%. And that is a huge impact. So that's where the buyers effectively got this extra impact, got that extra dry powder to say, oh yeah, I can bid more for houses. But what happens when that key aspect goes away, that interest, benefit that you have? And arguably, that's what you're seeing now. Now, does this mean that we are about to face another great financial crisis like we saw with many different banks collapsing, under the pressure of, the mortgage market effectively collapsing and all the, effectively the Jenga? You pull one piece and then the whole house of cards comes tumbling down. Well, let me share my thoughts after a quick plug where if you're looking to take charge of your investment journey, consider unrivaledinvesting.com, where you'll get actionable insights on an unrivaled company and a community of fellow investors that you can learn and share with. I also share my own personal investment journey for those interested in following along. A big thank you to all the Unrivaled Investing subscribers out there. And if Unrivaled Investing isn't in your budget, I do appreciate you hitting that thumbs up, hit that subscribe button. And so looking at this, asking myself, is this the next great financial crisis? I don't think so. The reason why is because what you saw, as I already mentioned, with the housing bubble previously that preceded the great financial crisis, is you saw it wasn't really interest rates that was the primary driver of the divergence between incomes and home prices. It was underwriting standards, where people said, hey, we're willing to write crappier loans. That's a problem when you own those loans. In this case, what's really happened is that interest rates have gone down so much, once again, because of the Federal Reserve, that's the reason why. Whereas over this time period, a lot of these banks have shored up. Now, that's not necessarily a call on all global banks. European banks, maybe Japanese banks might come under pressure. Not clear. I'm not an expert on those banks, and I haven't looked into detail on it. But I would say the U.S. certainly is more prepared for a housing downturn, especially after what happened previously. So then the question is, well, how bad, can home prices decline? So first recognize this isn't a Lehman Brothers sort of, collapse where you could see, oh my goodness, this bank goes down, then this bank goes down, and then all the Jenga pieces, and then the dominoes, and oh my goodness, what a mess. I don't think that's what you see here. I think you could see a recession for sure. And I do think, home prices could definitely take a hit because effectively that marginal buyer that previously could afford it no longer can with interest rates where it's at. So I do expect home prices to go down on a national perspective. Now, this is another key aspect. What I just said is I expect home prices to come down on a national perspective. This is much like the stock market, where I could say, and I did say last year, I called it out exclusively to my unrivaled investing subscribers. I said, look, I think the SPAC bubble is going to pop. I think it could get decimated. And that played out. But just because you call something out like that doesn't mean the whole market. Or you might find, individual pockets where you think you can get an attractive return. So it is worth understanding that there will be individual companies, with investing. So you could have the stock market fall. Like my top two positions were either flat or up during this period, while the stock market was coming under pressure. And so that's the point, is you can have very different local markets very specific niche markets versus sort of calling the macro. And you could be right on both. Local can go up while national can go down. So I'd say it really depends on one market at a time. But broadly, as many investors are experiencing, when you have these sort of national pressures that causes national pricing to come down, it is a headwind. And it is much harder to make money with homes, with either homes as an investment or homes as a passive asset that you own. And so that is, I think, a real headwind that investors are going to experience and homeowners are going to experience over the next few quarters and years. Now, the question is, how bad does it get and what ultimately happens to home prices? I think it's much like what happens to stock prices over time, is that once again, the genius, I've called out Stanley Druckenmiller so many times, and I think he's able to capture this key phrase, which is that liquidity moves markets. And the Federal Reserve is really in charge. And will they respond to high inflation? How serious will they respond to high inflation? If the Federal Reserve starts raising interest rates by 1% or 0.75%, then I would expect home prices and stocks to get bludgeoned very quickly. But if the Federal Reserve continues their sort of lazy approach of, maybe 0.25%, maybe 0.5%, maybe that's too much, then you could see sort of a continued levitation or just sort of flatlining with some assets. And so it really depends, as always, on leadership. How serious will the Federal Reserve be about cracking the back of inflation? And ultimately, when they do, if they do, and you see the economy also take a hit, you're going to have this sort of dance of, well, when is the Federal Reserve going to start supporting the economy? And will they support the economy even if inflation is hot? And that's going to be the really tricky question of what to own in that period, because it's effectively, well, inflation's still hot and the Federal Reserve might still have to print money just to sort of help out the economy. And so that's the challenge of like, well, how does that play out in that situation? I'll make a whole other separate video about that. But in all honesty, I called out my previous video with Ray Dalio talking about why he thinks stocks are trash, largely deals with this very element. Well, if you enjoyed this video on why I think home prices, national U.S. home prices, could come under pressure in the next few months and quarters in the U.S., please make a point of hitting that thumbs up, hit that subscribe button, and I'd love to hear your thoughts if you feel like I'm missing something. Thanks so much for tuning in.